of all, thank you for having me here. And special thanks to Junaid, Ashik, Faiz and Siddharthi for organizing such a wonderful event. Our topic today is behavioral finance. It's a vast subject actually, but we will go through some high-level summary. Behavioral finance actually combines behavioral psychology with finance theory to provide an explanation why people make irrational decisions. Okay, so understanding some basic behavioral finance will help us to deal with our own irrationality and also to avoid some common mistakes we do in our decision making. Okay, let's compare traditional finance with the behavioral finance. Traditional finance assumes that investors are rational men, like they have this perfect thinking, but behavioral finance says that investors are not rational, they are just normal people. They are subject to emotions and they have various biases and all. Traditional finance assumes that everybody, all the market participants have perfect information and they make the decisions with this perfect information. Whereas behavioral finance says that nobody has this perfect information, they have only limited information and they make the decisions with this limited information. Okay, the third assumption of the traditional finance is that traditional finance assumes that all the investors are perfectly selfish. No other matters impact them, or they are just more about only money. But what behavioral finance is that there are various other factors that also influence, also matters to the investors, such as the religious matters or the social factors and all. The last assumption of the traditional finance is that investors are risk averse. Like investors don't want to take risk, so they start with a risk-free return. And for any additional return they take, they need to be compensated by additional return. So basically it is the risk-return matrix. Based on that, the investors make the decisions. So on the other hand, emotional biases originate from the impulse or intuition. They are more about how you feel rather than how you think when you make the decision. When some outcome happens, the person tends to believe that he was able to predict that outcome. It is actually, out of the memory error or recalling error that makes him to believe so. They overestimate their degree of, prediction of the future. So over time, what happens is they overestimate their ability to predict the future. They start building up a portfolio that, that will be higher risky because they think that they can expect, what will happen in the future, and they will be going more with the very risky portfolios, and will finally ending up into trouble. Another consequence of this bias is that they will be often fighting with their wealth managers, because they think that they could forecast that what is going to happen. When some negative event happens, they often argue with the wealth manager saying that it was so obvious that it is coming. Why you couldn't foresee this event and avoid the losses? So they unfairly assess their wealth manager all the time. Now let's move to framing bias. Framing bias is like, a person answers a question differently depending on the way the question is asked. So when a question is asked, he will say yes, and the same question is asked in a different way, he will say no. See an example. We see that two containers there. Let's assume that one person who wants to avoid taking fat, like, he doesn't want to consume the fat. So when he sees the first container, he obviously will not buy that container because it's saying that it contains fat, 20% is fat. But at the same time, when it is presented in a different way, that is the second container, he might most probably buy that container because it's saying that it is mostly fat-free, 80% is fat-free. So here what happens is, we tend to think that it is in 90s, right? But actually it is 100. And everybody knows that it is a framing, even the retailers know that it is a framing, and customers also know that it is a trade. But they still, all these retailers keep that pricing because they know that it influences the decision of the customer. When they see 29.9 instead of 30, to some extent it influences their decision. Their risk tolerance will be assessed not correctly. When you go to the wealth manager for managing your wealth, normally there is a process called, they assess your risk tolerance. Risk tolerance are a combination of two factors. One is ability to take risk, and the other one is your willingness to take the risk. So ability to take risk can be assessed easily because that is your financial position. It can be assessed through your financial statement and all. But the willingness to take a risk needs to be assessed through the questionnaires and asking questions and all. So when a person asks differently, to the questions, the correct risk assessment will not be done. And finally, what will happen is there will be suboptimal portfolio created for him due to this bias. So that's about the framing bias. Now we will go to the conservatism bias. Conservatism bias is that a person has a belief, initial belief, and he is holding on to that initial belief. He is not, there will be some new information coming in, but he is not ready to update his belief with this new information. Let's see an example. That, for example, one person believes that Apple Inc. He believes that Apple Inc. is one of the best company in the world. Maybe true, but what happens is over the time there will be some new information coming in about Apple that will be contradicting his belief, but he is not updating his belief with this new information. There will be some red flags about the company coming in. He totally ignores this. We know what happened to the BlackBerry, Nokia and all. The same thing can happen to Apple. This is the confirmation bias. Here what happens is he has a belief, initial belief, and he is looking everywhere for confirming that belief. And at the same time, he will be ignoring the information which contradicts his belief. Okay, so he takes the new information, but only one part of the information. That is, where it is positive to, favorable to him, he accepts that, and he completely ignores or he downplays the information which is contradicting that belief. So that is the confirmation bias. For example, let's see that crypto. One person believes, just for example, one person believes that crypto is one of the best assets. One of the best assets. I wanted to say Apple, but it's already used, so I'm saying crypto. Just for the example. What I'm thinking is that crypto is one of the best assets in the world. Very true. Okay. So what happened? The problem here is we looking everywhere for the information that confirms that crypto is the best asset. And completely ignores or downplays the information which says or contradicts that belief. So that is the confirmation. Right? Here what happens is because you continuously searching for that favorable information, you will be building up some false confidence about that asset, and finally will be highly concentrating into that asset, and finally will be in a very risky portfolio. Anchoring bias is that you are anchoring all your decision around some default number. That default number can be anything, like the purchase price or the previous performance of the stock or some 52-week high price of the stock or anything. You are focusing all the decision around that default number. Just for an example, let's assume that one person has an apartment in Dubai and he wanted to sell that apartment. He got a deal of 1 million. Okay, for some reason that deal didn't go through. And after some time, say that 6 months or after 1 year, you want to sell it again. So what happens is the market condition have changed by the time after this period, and the price now may be 500,000 or 600,000, but he will be anchoring on that 1 million. The same thing can happen into the stock also. That when you purchase a stock at some price and the prospects of the company changed, and you are now very low price, but you will be anchoring on that purchase price and or keeping on holding that. So that is the cognitive errors. Now we'll move to emotional bias. The first one is loss aversion bias. Loss aversion bias that people feel stronger about losing the money than they do when they gain this equal or same amount of the money. But the pain from the loss is very high in magnitude than the gain. So I'll just say two scenarios. That is, in scenario one, an employee is told that he will be getting additional compensation of X amount if he carries out task A. In the second scenario, the employee is told that an X amount will be deducted from his compensation if he doesn't carry out task A. In both the scenarios, the task is same and amount is same, but the chance of carrying out the task will be high in this second scenario because there, you don't want to lose something. The first scenario you are gaining something, but second scenario you don't want to lose something. So here, the chance of carrying out the task will be more in the second scenario. Here the consequence is that he will be selling the winners. They will be selling the winners very quickly because they don't want that gain to be reversed or erased. So they will be selling the winners quickly. At the same time, they will be holding on the losers for a long time because they are holding the losers because they don't want to realize the loss. And finally, his portfolio will be full of losers. Another consequence is that when he incurs some loss, he doesn't want to accept that loss. Then what he will do, he will be going and taking very excessive risk to recover that loss, and finally will be getting into trouble. Status quo bias, as the picture shows, it's a Nike logo. There it says just do it, right? Here they just do nothing. Here what happens is when you have some portfolio, you don't make any conscious attempt to change the portfolio. You just maintain that same portfolio. It may be because of the inertia or laziness. A study shows that when they compared the major indices around 50 years ago and the same index now, what they found is around 70% of the stocks in that index 50 years ago are not existing now. That means they are either bankrupt or the eroded in value and it's nowhere. You hold the portfolio and don't make any changes, the same thing can happen to your portfolio. Similarly, in the mutual fund also, mutual fund normally there is an option to switch from fixed income to equity or from large cap to small cap and all. But people, they go with the default option, they don't make the switching. The consequence is that you will be missing the new opportunities. Because you are not exploring the new opportunity and you will be missing new opportunities. So when the opportunity means that you will be thinking, okay, I missed that opportunity. Second consequence is that you will be missing the value migration. There are always migration from now from the conventional IC automobile to electric vehicles. Migration happens. Now there is a migration going on to the AI and all. So when you are holding on a portfolio and not making the changes, you will be missing out that migration. For example, if the person has a store, a company that produces automobile parts of conventional automobile. Since everything is moving to the electric vehicle, if he is holding on to that company may not be existing after some time. Next is overconfidence bias. I think I don't need much to explain on the overconfidence bias. Everybody knows what is overconfidence bias. It is from overestimating one person's ability or the knowledge level, or overestimating the access to the information and all. Creates that kind of false confidence, and the person will be going, mainly underestimating the risk and overestimating the expected return, and you will be holding poorly diversified portfolio. You will trade excessively, and what will happen is you will experience a lower return than the market normally. One of the very important bias which the investors should know, in my opinion, is a regret aversion bias. Here, the person wants to avoid the regret of making a decision or not making a decision. There are two types of regret aversion. One is regret of omission and regret of commission. Regret of commission is a regret of making a decision, and regret of omission is a regret of not making a decision. He doesn't want, I said, when you go, you will understand more. So what happens is, he tends to confirm, I'll just repeat one second, that, here the person wants to avoid the regret of making a decision or regret of not making a decision. Okay? So there are two types. One is the regret of omission. Omission is the regret of not making a decision, and the other one is the regret of commission, regret of making a decision. So when we go through, we'll understand more. So here, the person tends to conform with what others do. He follow it. It's like a herd mentality. He'll be going, following the herd mentality and going with others. And he'll be mostly investing in popular investments to avoid the future regret. And they don't normally care about the fundamentals, or they don't look whether it is a good time to buy or not. Normally they buy very high and sell very low. So what happens is, when the stock go up and up, they will have this fear of missing out triggering in, and then to avoid that regret, they will go and buy at very high price. Okay. Similarly, when the price is going down, then this panic will be kicks in, and they want to avoid that, regret, and they will be buying instead. And we know that what happens when you buy high. Normally, market reacts, overreacts always. It's mainly because of these people's behavior. That is, when market goes up, it will go far above. And similarly, when the market goes down for some reason, these people will be panic and will be further sell happens, and that makes the things worse. And it will be market will be going further down. So that's why this market always overreacts. Actually, this overreaction itself is providing an opportunity for the investors. We saw that what happened in the March 2020. Almost all markets crashed almost 50%. Okay, for example, Sensex, it was trading at 50,000 levels, crashed to 27,000, and it doesn't make sense, right? In a very short time period, market crashed almost 50%. It doesn't make sense. After a few months, market was again back to 50,000 by December 2020, when the COVID was still going very strong, and the market is back to 50,000. So this all reaction is mainly because of this behavior. Ajay, you're okay? So now you asked me some right. So now the question about moderate or adapt. This question, whether to moderate or adapt, depends on two factors. So mainly, one factor is that the type of the bias gap. If it is cognitive type of errors, that is easy to correct with the proper, setting up a proper investment, decision-making process, and all. But if it is emotional biases, that's not easy to correct. In that case, the person may have to adapt to that biases. But again, adapting depending on another factor, that is your standard of living risk. If you are a wealthy person, any small wrong decisions and all may not impact your wealth, and your standard of living will not be impacted. In that case, you can adapt. But if your financial situation is not that good, that time you cannot adapt to these biases. In that case, you will have to seek a professional advice of a wealth manager or asset manager. Next is mitigation of these biases. A very important factor in mitigating the bias is that understanding the bias. It's not easy to understand. It takes time and effort to understand the bias. Before making any decisions, whatever decision you invest in a property or buying a stock, especially for the long-term investment, I'm saying, not for the trading. When you invest in a stock or property, you need to make a note of everything. The rationale behind making that decision. What make you to make that investment? What are the positives and negatives, and how you deal with that negative parts. And even in a small calculation, what you expect, what is current earning per share, and what is the growth you expect, and the reason for that expectation. And if there is any PE expansion, what is the current PE, what is the PE you expect in the future, and what will be the expected return. And finally, all the conclusions, and then give it a time. And after some period, you go back and review your performance and also the note. So that time you will come to know, where you went wrong and what actually influenced your decisions at all when you continuously do this practice. Apart from that, other methods are, the good planning, report maintenance, checklists, all these things. And this behavioral bias, to avoid the behavioral, to mitigate the behavioral bias, what you have to do, you have to make a proper disciplined investment decision-making process. When you have that proper process, then your feelings, emotions will not get inside, will get into your decisions. So that's how you can mitigate this bias. So thank you very much. I know it's a little weighty subject, so it may not be very easy to digest.